Hey everyone, welcome back to Corporate Decoder, the place where we help you understand the money moves behind the scenes. You know, sometimes reading these financial reports feels like deciphering an ancient scroll. But today we're going to break down Packaging Corporation of America's latest report and see what secrets it holds for us, the investors and everyday people. Alright, so Packaging Corporation of America, or PCA as they're known, has just dropped their quarterly report. And while it has a lot of numbers, we're going to focus on the story those numbers tell us about where the company is headed, particularly after a pretty big move they made recently. Let's dive right into the heart of it, the financials starting with their income statement for the third quarter, ending the 30th of September 2025. Their net sales were pretty solid at $2.3 billion, that is up from $2.18 billion in the same period. Last year, a nice bump of over $100 million. Now, where did that extra money come from? Well, a big chunk of it came from their packaging segment, which saw sales jump by almost $120 million. This is largely thanks to their recent acquisition. We'll talk more about that later. But essentially, they bought a containerboard business that is now contributing to their top line. The paper segment also saw a small increase in net sales by about $2 million. But overall, the star here is the packaging business by a long shot. When we look at gross profit, which is what is left after they pay for the materials and labor to make their products, it held pretty steady decreasing. Just $1 million year over year. This means even though sales went up, the cost to produce those goods also went up proportionally. That is not ideal, but it is not a disaster either. Their selling, general and administrative expenses, those are the costs of running the business, like marketing and salaries, actually went down by about $8 million. That is good news, showing some cost management. And that brings us to income from operations, the profit they make before things like interest and taxes. This actually went down slightly by $3 million. The reason for this small dip is a bit complex, but it boils down to higher operating costs, lower volumes in some areas, and increased expenses from that big acquisition we mentioned earlier. Now, for the bottom line net income for the 3 months ended the 30th of September 2025, PCA reported $227 million. That is a little less than the $238 million they reported in the same quarter last year. This slight decrease primarily reflects some one-time costs associated with the Greif acquisition, which we'll get. 2. Tying this to earnings per S-share, which is how the profit is divided among each share of stock diluted earnings. Per S-share were $2.51 compared to $2.64 last year. Again, a slight dip mainly due to those acquisition related costs. Now let's pivot to the balance sheet, see what the company owns, what it owes, and the value of the owner's stake. As of the 30th of September 2025, total assets swelled to a hefty $10.98 billion. That is a significant jump from $8.83 billion at the end of 2024. A big reason for this asset increase is property, plant, and equipment, which grew from $4 billion to over $5 billion. This clearly shows investment in their physical operations, likely tied to that acquisition. And then there is goodwill. This is essentially the premium paid over the fair value of identifiable assets in an acquisition. And it surged from $922 million to nearly $1.2 billion. This massive jump is a direct indicator of the significant acquisition they completed. Similarly, other intangible assets also saw a huge leap from about $191 million to almost $700 million. This indicates they acquired significant brands, customer lists, or other valuable intellectual property along with the business. So overall, their asset base has grown significantly, driven by big investments, probably in the packaging sector. Now let's look at the liabilities. Total long-term debt also jumped dramatically from $2.47 billion to $3.97 billion. This tells a story of significant borrowing to fund these investments. Despite the increased debt, stockholders' equity also grew from $4.4 billion to $4.75 billion. This suggests that while they borrowed a lot, they also managed to increase the value of the company for its owners. Moving on to the cash flow statement, this tells us how cash is moving in and out of the company over the 9 months ending the 30th of September 2025. Cash from operations was strong at $1.11 billion, an increase from $866 million last year. This is positive, showing the core business is generating a healthy amount of cash. But look at investing activities. Wow, they spent a staggering $2.28 billion here compared to just $75 million last year. This is where that big acquisition really shows up. It was a major cash outflow. Specifically, the acquisition of a business cost them $1.8 billion. This was clearly the main event this period. And for financing activities, they saw a huge inflow of $1.12 billion compared to a use of $763 million last year. This is because they borrowed a lot of money to fund that acquisition, bringing in cash through new debt issuances. All these big movements in investing and financing activities resulted in a net decrease in cash of $51 million, which is a change from the increase of $28 million last year. This is expected given the massive acquisition. Let's look at segment information to understand performance packaging segment sales grew significantly to $6.1 billion for the 9-month period, up from $5.7 billion last year. This growth is fueled by higher prices and the newly acquired business, as well as a slight increase in legacy volume. The paper segment, however, saw a slight decline in net sales to $461 million, down from $473 million last year. This is attributed to lower sales volume, even though prices and mix saw a small increase. When we look at profitability adjusted for one-time items, packaging segment EBITDA excluding special items was $1.35 billion, up nicely from $1.17 billion last year. This segment is definitely the engine of the company. The paper segment's EBITDA excluding special items remained pretty flat at around $110 million for both periods. This indicates consistent but not growing performance. Overall income from operations for the 9-month period jumped to $938 million, up from $799 million last year. This shows strong underlying operational performance before considering interest and taxes. Now, for some context, the big news here is the Greif acquisition completed on the 2nd of September 2025. This added 2 containerboard mills and 8 corrugated plants to PCA. Portfolio, they paid a hefty $1.8 billion for this business. This is a significant strategic move, likely aimed at expanding their market share and operational capacity in the packaging sector. PCA also provides non-GAAP measures like earnings per diluted share excluding special items. These are important because they try to show the ongoing operational performance by stripping out one-time costs like those associated with the Greif acquisition. Looking at earnings per diluted share excluding special items for the 3rd quarter, it came in at $2.73, up from $2.65 last year. This shows that if you ignore those one-time acquisition costs, the underlying business actually improved a bit year over year. In the packaging segment, EBITDA excluding special items for the 3rd quarter was up to $491 million from $445 million in the prior year. This improvement is driven by higher prices, mix, and lower fiber costs. Even though volumes were a bit lower, this is a sign of good pricing power and cost control in their core business. Scroll to start explaining risks and legal sections. Now let's talk about the risks and challenges. Let's be honest, every company has them. And PCA is no different. One of the biggest risks they highlight is the integration of the Greif containerboard business. They warn that it might underperform expectations and that integrating it could be difficult, costly, and time-consuming. This is a crucial point because a poorly integrated acquisition can drag down a company's performance. And then there is the debt. They've significantly increased their borrowing from $2.48 billion to almost $4 billion this increase. And leverage means they have more interest payments to make, and it makes them more vulnerable to economic downturns, especially if their earnings don't keep pace. The report explicitly states this could limit their flexibility for future investments and acquisitions. This is a classic trade-off, more debt for growth, but it comes with increased financial risk. On the legal front, there is a new class action lawsuit filed against PCA and other containerboard producers, alleging Price fixing the company believes the allegations are without merit and will defend itself vigorously. This is a serious matter. An antitrust case could result in substantial fines and damage their reputation. So what is the big picture here is my take on Packaging Corporation of America after reviewing this report. PCA is making some very bold moves. They're clearly committed to expanding their presence in the packaging market through acquisitions. The Greif acquisition is a massive undertaking that has significantly boosted their assets and debt levels. The good news is that their core packer, Jing, business is showing resilience with strong pricing power and cost management. Even with some volume challenges, the paper segment is stable, but not really a growth driver. The big question mark is how successfully they will integrate the acquired Greif business and manage their significantly higher debt. Load the antitrust lawsuit is also a cloud hanging over them. It could be a major distraction and fine and seat. I'll drain if it goes against them. In essence, PCA is betting big on the packaging sector. It could pay off handsomely if the integration goes smoothly and the market continues to support higher prices. But the increased debt and legal risks mean investors should watch this one very closely for the next few quarters. Alright, that is our deep dive into Packaging Corporation of America's late Sant financial report. What do you think about their acquisition strategy and the potential risks? Are you bullish or bearish on PCA? Let us know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe to Corporate Decoder for more simplified financial insights. We've also got a thriving community over on Discord. Check the link in the description to join the conversation. Thanks for watching, and we'll see you in the next video.